trading. For a lot of people, it brings up images of, well, quick wins, maybe quick losses too, a real high-stakes gamble.
Hmm.
But what if we looked at it totally differently? What if we treated trading like running a business?
Well, that's exactly the idea we're digging into today. We're using Dick Diamond's book, Trading as a Business, as our guide.
Mm-hmm.
And this isn't just theory. Diamond has, what, over 40 years of actually beating the
Yeah,
markets?
4 decades, 40 years of navigating all the ups and downs and, consistently coming out ahead. That's pretty impressive.
It really is. And his book isn't about chasing those huge lottery ticket type wins. It lays out the actual methods, the rules he's used all that time for steady profits.
Right. We've got excerpts here that dive into his core philosophy, the huge importance he places on emotional discipline. We'll definitely talk about that, and even some specific trading templates he uses, I think, with the Metastock platform.
That's right, Metastock. So our mission today, really, is to get a handle on Diamond's philosophy for that kind of sustained success. We're focusing on what he keeps coming back to, controlling your emotions, managing risk really carefully, and spotting those high probability trades he calls 80-20 trades.
And here's the thing that really hooked me. Just think about it. Decades of profit, still doing it into retirement age, no boss breathing down his neck, no employees to manage, just steady income.
Yeah.
That just flies in the face of the usual picture, right? The frantic, stressed out trader always chasing the next big score. Diamond's way seems, well, calmer, more sustainable.
It definitely does. He sees it as a long-term business.
Oh.
Making money, yes, but the focus is really on avoiding those big losses and just consistently grabbing smaller profits from short-term market swings.
Small profits consistently add up, I guess.
Exactly. And the fact that he apparently rarely has a losing week, let alone a losing month, that says something about the approach working.
Okay, so let's really get into this trading as a business mindset. What are the key parts of that, according to Diamond?
Well, first off, it's that long-term view. He talks about the advantages, like the flexibility you have. You choose what to trade, when, how much capital.
No customers, no staff.
Right. No product to manage. Transactions happen instantly. But, and this is key, the success or failure, that's all on you. Sole responsibility.
That sounds both freeing and maybe a bit daunting. A lot of pressure.
It is, and that's why he stresses self-reliance so much. Do your own homework, your own analysis, make your own trades. He says, learn from others. Sure, his best students adapted his methods, but you have to integrate it, make it your process.
So no shortcuts like just copying someone else.
Definitely not. And he really pushes against that whole get-rich-quick thing, the lure that pulls so many people in. His focus is, like Robert Prechter said in the foreword, on chopping it out every day. Methodical, businesslike, steady gains, not jackpots.
Okay, you mentioned emotional discipline earlier. He calls it the #1 reason traders fail. That's a huge claim.
It is huge, and he really hammers it home. For Diamond, it boils down to two things. Patience waiting for the right situations, and then decisiveness acting when they actually show up.
Sounds simple enough, but I guess it's not in practice.
Apparently not. He says lack of discipline causes most mistakes. Like forcing trades when the odds aren't great, maybe you're just bored or feel like you should be trading.
Or the opposite, hesitating.
Exactly. Hesitating when your system says go, and then on the exit, holding losers too long, just hoping.
Hoping it turns around.
Yeah. Or grabbing profits way too soon because you're scared, or conversely, getting greedy and holding too long, giving gains back.
That sounds incredibly human. You can see that in, well, lots of parts of life, not just trading.
Absolutely. He uses a weight loss analogy, which I thought was interesting. Like, we all basically know the principle, eat less, move more, but doing it consistently. That's the hard part, discipline.
So knowing the strategy isn't enough.
Not even close. It's the consistent, disciplined action, emotional control that makes the difference. He actually recommends a book, Emotional Discipline, by Charles Mans, for understanding emotions in decision-making better.
Okay, emotional discipline, got it. Crucial. Now, what about this core position idea? What is that and why is it so important?
The core position, okay, Diamond defines it as your trading size, specifically the size you can trade without your emotions getting triggered.
Meaning
You're not overwhelmed by, like, crazy hope if it goes up a bit, or paralyzing fear if it dips, or just pure greed. It's the size where you can still think clearly.
Ah, okay. So finding that sweet spot where you can stay objective.
Exactly. He argues sticking to that core position is absolutely fundamental for long-term success. You want trades to work, obviously. But if one goes bad, you need to be able to cut it loose for a small, manageable loss without it wrecking you emotionally.
And if it's winning?
Same idea. Take the profits when your plan says to don't get greedy and hang on forever, or bail too early just because you're nervous about losing the gains.
Does he give his own example? Like, what's his core position?
He does. He mentions his max is usually around 10 E-mini contracts. For context, that's like 2 S&P 500 futures contracts. And even if a trade starts off great, he typically won't just pile on beyond that core size.
And for listeners trying to figure out their core position, what's the advice?
It's about finding what lets you trade unemotionally based on your own capital. If you've got a few $1,000s, maybe it's a small number of shares. The point is finding that level where your emotions don't hijack your decisions and make you ignore your rules.
Right. Now, let's talk about what he calls the destructive emotions: greed, fear, impatience. Let's start with greed. How does that mess things up?
Greed. Well, the obvious way is pushing you to risk way too much, ignoring your system, your rules, because you see dollar signs.
Holding on to losers, hoping for that miracle turnaround.
Yep, that too. He really warns against focusing too much on the outcome, like picturing what you'll buy with the profits. That distracts you from just executing the trade properly, following the process.
Stay focused on the process, not the prize.
Exactly. And it can be subtle, too. Like after a winning streak, maybe you feel invincible and bump up your position size way beyond your core. Or you start taking iffy trades, ones that don't quite meet your criteria based on a gut feeling. He even cautions against setting really rigid profit targets, because sometimes chasing that specific number can lead you to do undisciplined things.
Interesting. Okay, what about fear? How does fear sabotage traders?
Fear, he says, often stems from a lack of confidence. Maybe you don't fully trust your trading signals, or you doubt your own ability to stick to the
Or
rope.
just fear of losing money, being undercapitalized.
Yeah, all of that. Fear of loss, fear of failure. Makes you expect the worst. Hard to read the market clearly. Hard to stick to the plan. It could lead to that paralysis by analysis. You just overthink everything and can't pull the trigger.
So really knowing your strategy, having a solid system, that helps fight the fear.
It's a big part of it, definitely. Diamond stresses studying your setups, getting comfortable with your indicators, really internalizing your rules, and then executing trades according to plan in the real market builds that confidence over time.
Makes sense.
He also mentions loss aversion. You know, how losing $100 feels way worse than gaining $100 feels good. That psychological quirk can make people terrified of taking even small, necessary losses. He says accepting losses as just part of the business is absolutely vital.
And the last one, impatience. I can definitely see that being a problem, especially today.
Oh, yeah. Impatience leads to overtrading, feeling like you have to be in the market, doing something, chasing action. Diamond says that's usually a recipe for losing money long term.
So it's about waiting.
Waiting patiently for those high probability 80-20 trades he talks about. He mentions days where he just sits there and doesn't make a single trade because the right setup doesn't appear.
Wow, that takes discipline.
It does. And setting realistic long-term goals helps too. Avoid that get-rich-quick trap. Manage your expectations.
Okay, mindset, emotions. Let's get into some of his actual principles of successful trading. He lists quite a few. Where should we start?
How about trade within your capital? This ties right back to the core position idea.
Okay.
Diamond's point is simple. Everyone has losing trades, even the best. To stick around, your losses have to be small compared to your total capital. Risk too much on one trade, and you could blow up your account or at least destroy your confidence.
He has that analogy about account growth too, doesn't he?
Yeah, the turtle versus the Ferrari. He says beginners especially need realistic goals. Focus on learning the ropes, making modest profits, taking small losses, survive first, then think about growing the account steadily, like a turtle.
Not trying to be a Ferrari right out of the gate.
Exactly. And don't ramp up your size just because you had a few winners. A losing streak is probably around the corner.
Okay, another principle. Quiet confidence. What does that mean? Is it just being sure of yourself?
It's not really arrogance, he says. It's more like an inner assurance that comes from doing the right things consistently, following your rules, taking good trades, managing risk, staying disciplined.
And trusting that good results will follow over time.
Precisely. It's knowing that you're in control of your actions, unlike gambling where you just place a bet and hope. With his approach, you make deliberate decisions based on your system.
Okay, here's one that sounds a bit counterintuitive. Sell too soon, not too late. What's the logic there?
Yeah, that goes against the common let your profits run advice, right? But remember, Diamond's mostly a short-term trader focused on those 80-20 setups.
So he gets in and out relatively quickly.
That's the idea. He argues that huge, sustained, one-way market moves all day long are actually pretty rare. Markets usually chop around, pull back. So if you hold on too long, hoping for that massive trend,
You risk giving back your profit.
exactly, you might give back a chunk of it or even miss the next good setup that comes along. His philosophy is more like take a reasonable piece of the pie while the momentum's there, then move on. Don't get greedy and wait for the absolute top because you'll probably miss it and get caught in a reversal.
Avoid wishing and hoping.
Right. Trade the probabilities.
Okay, wait for 80-20 trades. We've touched on this, the high probability setups. Anything more to add?
Just that it's really the foundation of everything. It takes serious patience to sit and wait for those specific conditions to line up on his template before you act. No trading just based on a hunch or a feeling unless the template confirms it.
He calls himself a sore loser.
Yeah, meaning he hates losing, so he avoids those borderline maybe 60-40 situations. The potential profit isn't usually big enough to justify the higher risk of hitting a losing streak, which hurts your capital and your discipline.
Makes sense. Then there's play great defense. Sounds like risk management again.
Totally. For Diamond, defense is priority one. Control your risk before you worry about maximizing profit. How? Emotional control, cutting losses quickly, sticking to your rules religiously, and keeping your trade size small relative to your capital. Don't get attached to losers. The market always offers new chances if you protected your capital.
And pull the trigger. Decisiveness.
Yes. Once you've done your homework, you see that 80-20 setup appear based on your template, your plan says go. You got to act. Don't freeze up with paralysis of analysis. These opportunities don't last forever. Other traders see them too, and the market moves.
Gotcha. Opinions are for pundits, not traders. Pretty blunt.
Very direct. He says trade what your system tells you, the objective signals from your 80-20 setups. Not your own gut feeling about where the market should go, and definitely not what some talking head on TV says. Start each day with an open mind, ready to go long or short, based purely on the template signals.
Okay. And use defensive stops. Seems obvious, but any specifics on how he uses stop losses?
Obvious, but crucial. He says set one for every trade, no exceptions, and stick to it. He usually places his initial stop fairly close to his entry, just to limit the damage if it immediately goes wrong.
And if the trade goes right?
Then you adjust the stop to lock in some profit, trail it up or down for a short. So worst case, you break even or make a small gain, create a risk-free trade. Again, he prefers exiting while momentum is good, not waiting for it to stall. And he generally gets out of losing positions before the market closes, avoids that overnight risk.
Okay. Track your results. Why is record keeping so vital?
It keeps you focused, lets you see what's working, what's not, objectively over time. Your P&L will bounce around with the market, sure, but tracking helps you focus on what you can control. Your discipline, following your rules. He says review your trades. Did you follow the plan? That helps make the rules automatic.
And the last principle, review the rules every week. Constant reinforcement.
Exactly. Don't just read them once. Reread them, internalize them, make them second nature. He believes if he'd done that consistently from the start, his own path to profitability would have been much smoother. Regular review makes him stick.
Okay, so he relies heavily on these trading templates in Metastock Pro to find the 80-20 trades. Can we get a practical feel for how they work? Maybe using the moving average template as an example?
Sure. So these templates combine specific technical indicators visually to flag those setups. The moving average one uses 3 exponential moving averages, or EMAs, a fast one, 21 period, medium 55 period, and slower, 89 period.
Moving averages just smooth out price, show the trend.
Exactly. And it also uses the Williams-Broussard indicator. That's a momentum oscillator, helps spot potentially overbought or oversold conditions.
So how does he put those together to get a signal?
Generally, a potential buy signal comes when the moving averages line up bullishly, shorter ones above longer ones, all sloping up, and the Williams-Broussard moves into bullish territory, which for him is usually below the NAG level.
Okay, trend and momentum agreeing.
Right. And conversely, a potential sell signal might be the MA is aligned bearishly sloping down, shorter below longer, and the Williams-Broussard entering bearish territory, typically above -20. The key is waiting for that confirmation, that agreement between the trend MAs and momentum Broussard.
The book has figures showing this. Can you walk through an example, maybe figure 5.3?
Okay, yeah, figure 5.3. Early in the day, price starts moving up. Williams-Broussard crosses below Angle 80. That's bullish momentum. And crucially, the moving averages are also aligned bullishly, sloping up.
So, signal conferred.
That's a high probability long setup by his rules. And in that example, the market did keep going up, profitable trade. Later, there's a pullback, Purcell goes bearish, above -20. But look, the moving averages don't confirm a downtrend.
So no trade there.
Right. Then the market turns up again. Purcell goes bullish again. The fast MA turns up. Another potential long entry, confirmed by the indicators realigning.
So it's really about waiting for that confluence, that agreement between the indicators.
Exactly. He really stresses waiting for confirmation across multiple indicators. Like in figure 5.2, maybe Purcell goes bearish early. But if the MAs don't agree, it's a no-go. Or Purcell spikes bullish, but the MAs aren't aligned upwards, yet you wait.
Patience again.
Always. Figure 5.5 is another good illustration. Opens bullish, MAs look good, Purcell is bullish. But then Purcell quickly tanks. Warning sign. Weakening momentum. Avoid that trade. Later, KRSR recovers into bullish territory. MAs are still bullish and rising. Okay, maybe a long trade there, though he notes it might only be a small win or break even.
So you're constantly assessing if the signals remain aligned.
Yes. And he shows examples where an initial signal fails, maybe the market stalls, and then later sets up a valid trade in the opposite direction when all the indicators finally align bearishly, for instance.
And he's typically looking for, what, 3 to 5 indicators in a template to line up?
Yeah, that's key, not just one or two. Markets are complex. You need that combined signal from 3 to 5 indicators within the template, all pointing the same way, to get that high probability edge. And remember, the book covers 3 other templates, too. Moving Ribbons, Bressard, RMO, each using different indicator combinations like MESCD, stochastics, some proprietary ones.
So the templates aren't just signal generators, they're like a framework for disciplined trading.
That's a great way to put it. And he strongly recommends, if you're interested, watch these templates in real time or paper trade them. Simulate trading without real money. Build your own conviction. Reading about it is one thing, seeing it work or not work in live markets. That's how you build the confidence to actually act on the signals when it's real money.
This has been really fascinating, really digging into Dick Diamond's approach in trading as a business. To wrap things up, what are the absolute must-remember takeaways for listeners?
I think the core messages are pretty clear. First, treat trading like a serious long-term business. That demands unwavering emotional discipline. Second, control your risk obsessively, mainly by sticking to your core position size. Third, cultivate patience. Wait for those high probability 80-20 setups.
Don't just trade for the sake of trading.
Exactly. And finally, commit to your rules. Follow a well-defined set of principles and use reliable tools like the templates Diamond uses consistently. Discipline, risk control, patience, process.
And maybe a final thought for everyone listening. Think about Diamond's career. Decades of consistent success, quietly profitable, not making huge headlines. What does that steady, maybe even unexciting approach tell us about what really works long-term in trading and investing? Is the secret maybe less about finding some magic formula and more about just applying sound, maybe even kind of boring principles with incredible discipline day after day, year after year? Definitely something to chew on.
It really is. We'd encourage you to think about how those core ideas, especially emotional discipline and managing risk, could apply to your own financial life, even outside of active trading.
Good point.
And if you are interested in trading, maybe look into technical analysis, explore some of those indicators we mentioned, moving averages, Williams-Purcell, MACD, stochastics, and the others. They could be a good starting point for your own research. But always remember, Diamond's emphasis. Backtest. Build your own conviction before you put real money on the line.